Hey there, Brad Castor from GreatOptionTradingStrategies.com. There's this great quote from the late Czech and French writer Milan Kundera. Happiness is the desire for repetition. When we find something we really enjoy, we want to keep doing it. We don't want it to end. But when it comes to selling puts for high yield income, while you might want a winning trade to go on forever, sometimes it's best to say goodbye, and well before expiration. That's what we're going to cover in today's video. When should you exit a winning put selling trade early? Get this right, and you're definitely going to improve your trading results. Specifically, we're going to look at the two key factors I personally use and teach others to use to know when it's time to say adios to a short put position and lock in your gains. Before we dive into all that though, I'm assuming you're here because you're either already an option seller for income or you find yourself drawn to selling options for income. If so, a quick word on a lot of free option trading resources I've put together over the years, which you might also find useful. I've been trading options, primarily selling them, since 2002. And I also launched the Great Option Trading Strategies website a long time ago. During the 17 years the site's been around, I put together a ton of comprehensive, free, quality option trading resources, from downloadable special reports and trade case studies to hundreds of articles on selling options for income, as well as incorporating options into value investing and dividend growth investing portfolios. Links for all that in the description below. Finally, real quick, if you liked today's video, I think you'll love my daily option tips and insights newsletter. I'll pin a link in the comments below for you to check it out. Whether you're selling options for income, leveraging longer term returns via leaps, or building either a value investing or dividend growth investing portfolio, I can show you how to make more money in the stock market quicker and safer. Best of all, I don't spam, sell your information, promote third-party services, or any of that. Once per calendar year, possibly twice, but usually not, I may invite you to join my option trading private membership site, the Leveraged Investing Club. But 99% of the time with the newsletter, I'm simply teaching and sharing and literally trying to help you become a better trader and investor. So on that note, let's look at how to know when to exit a winning put selling trade early. And I'm going to use a recent real-world trade that we did inside the Leveraged Investing Club to demonstrate these principles in action. Today, we're only considering winning trades, of course, but inside the club, we manage all of our trades, the winning ones as well as anything that winds up in repair mode, based on the same two principles or factors: remaining time value and basic technical analysis. So let's look at remaining time value first. Now, it's very simple. If you sell an at, near, or out of the money put on a stock, meaning you sell a put at a strike price that's at, near, or below the current share price, and then the stock moves higher, that put is going to lose a significant amount of time value. How much time value it loses will depend on how big of a move we're talking about, and also the time frame in which it makes that move. And that's great because you want your short puts to lose value. But what that means specifically is that there will be times when you can lock in the bulk of a trade's maximum potential gains in a fraction of the original scheduled holding period. So let's look at this trade we did earlier in the year inside the Leveraged Investing Club so you can see exactly what I'm talking about. Back on January 13th, 2025, with Nike trading at $72.54 a share, I sold a single February $70 put for $1.18 a contract. We sold puts on Nike at this level primarily because of technicals. The stock had successfully retested a key support level going back to the previous August, and it also bounced off an oversold RSI reading, so we were pretty confident that the near-term bottom was in. Also, quick side note, I always enter official club trades as single contract positions to demo the strategy, but inside the club we have position size guidelines that help you determine an appropriate opening position size based on the size of your brokerage account as well as your own personal comfort level. Okay, after commissions and fees, I received $116.87 in premium. That would work out to be a very respectable 15.63% annualized ROI over 39 days, assuming I held a position until expiration and it expired worthless, which is what would happen if Nike was still trading at or above $70 a share at expiration. That's also right in line with the 15 to 25% annualized rate we target when opening new put selling trades. And as you can see in the chart here, the thesis and timing were both spot on, and Nike had a nice little run over the next 2 to 3 weeks as the stock traded into the upper 70s. Now, I didn't nail the exact near-term top, but 15 days later, with Nike trading at $75.06, I was able to buy to close my short put for just 33 cents a contract. My final profit on the trade, after commissions and fees, was $83.74 over 15 days, which worked out to be a 29.11% final annualized ROI on $7,000 of cash secured capital. In other words, by exiting early, we basically doubled our annualized returns. That's because our puts lost a lot of value and we were able to buy to close them on the cheap. Part of that loss of value was from the passage of time, of course, as 15 days did come off the trade. But the much bigger factor was that the stock traded higher over those 15 days. When we entered the trade, Nike was trading at $72.54 a share. When we exited, the stock was trading at $75.06. In addition to doubling our annualized rate, we also freed up capital way ahead of schedule as a 39-day trade was reduced to just 15 days. But you might be thinking, yeah, but exiting early meant fewer total dollar profits. Wouldn't it be better to accept a lower annualized rate if it meant a higher payout? Because if you exit a trade early, now you have to find a new trade to replace it. But here's where our friend the annualized metric comes in. It's not just a tool that shows you projected returns and final returns. It's also a tremendous trade management tool that will really help you determine when to exit a winning trade early. And that happens when you annualize what you're leaving on the table. In other words, you can look at a winning trade and say, hey, if I exit the trade now, I can lock in X amount of profits, and that will result in such and such an annualized gain over whatever the holding period is to date. But that also means you can determine what portion of the trade's max potential gains you're forfeiting by exiting early. Now, when you annualize that against the time remaining until expiration, it can be a very eye-opening experience. So let's do that on the Nike trade. Again, the original projected return was $116.87 or 15.63% annualized over 39 days. And the final walkaway return from the early exit was $83.74 or 29.11% annualized over 15 days. So what that means is that I left $33.13 on the table with another 25 days to go until expiration. And when we annualize that, it works out to be a pretty anemic 7.20% annualized rate. In other words, I could collect that last $33.13 if I really wanted it, but I would be accruing it at a pretty unimpressive pace. Or think of it another way. If I viewed this as a brand new opportunity, would I ever enter a trade where the target return was a 7.20% annualized rate? I don't know about you, but it doesn't sound very tempting to me at all. Now, is there some magic cutoff rate where if what's left on the table is above that rate, you keep the trade going, and if it's below that rate, you close it down? I'm much more of a principles-based person than a rules-based person, so I don't personally have a specific number in mind. I still always take things on a case-by-case basis, but I will say that once the remaining time value on a trade slips below 10% annualized, I'm going to start monitoring the current option pricing more closely. And definitely, if the annualized rate on what's left hits the mid-single digits, it's very likely that I'm going to shut her down. Okay, hopefully the remaining time value factor is very clear. But there's a second factor that may also lead me to exit a winning trade early, even if it means that I leave more money on the table than I'd like. And that's the basic technical analysis factor. If the technicals are flashing some kind of warning sign that the stock may be at an increased risk of pulling back in the coming sessions, that's a good enough reason for me to lock in whatever gains I have at the moment. When it comes to a winning trade situation, which is what we're discussing, the warning sign I most often get from the technicals is that the stock has traded higher but is now running into some sort of resistance. Doesn't mean the stock can't break through that resistance, but at the same time, I don't want to be in a position where I need the stock to break through. In fact, most times I won't wait around to see if the stock breaks the resistance or is rejected. Because if it is rejected, my short put position is now increasing in value, which I don't want, of course. And there may be too much time value put back on the trade to make it appealing to exit ahead of schedule, as the stock is now moving back in the direction of my strike price. Hopefully this makes sense. Again, this is a situation where we've sold puts on a stock and the stock moves higher from there. But if there's a point where further near-term upside starts to look questionable, it's a perfect time to consider closing the books on the trade. There are also other technical indicators that might suggest something similar, like some kind of bearish candlestick pattern or a technically overbought RSI reading. The common denominator, or rather the underlying principle, is that ideally, if you can help it, you don't want to have an open put selling position on a stock that starts heading lower, even if your short put position is, at the moment at least, comfortably out of the money. So let's look at the Nike example again. To review, from a technical perspective, we sold $70 puts on Nike after the stock successfully held the $70 key support level, which is also where the stock had bought in the previous summer, and after it was coming off an oversold RSI reading. But I bailed 15 days later when Nike seemed to be struggling around the $75 share price level. You can see that with the red candle in the second highlighted area, which was also a bearish Harami candlestick pattern. And although I didn't draw in any resistance lines, you can see just by looking at where the stock had traded previously that there was a lot of congestion in the 75 to say 77.50 range. And again, as you can see in the chart, I did not perfect the exit. Nike actually had more upside before it started pulling back. And if it hadn't been for that bearish Harami on January 28th, I probably would have let the trade run a little more, even though, as we've already seen, on a remaining time value basis, it was still a good exit. Okay, one other quick observation about these two factors helping us know when the optimum time is to exit a winning short put trade. It doesn't always work out this way, but you'll often see both factors triggering an early exit at the same time. That makes sense, doesn't it? With our approach, we're selling puts on attractively valued stocks after they've successfully tested a key support level. We don't need the underlying stock to go up, of course. It's enough that it just doesn't trade lower, or lower by much. But under these circumstances, the stock does often, in fact, trade higher. And if the stock bounces higher to the point where it's now running into a technical resistance area, then by definition, the short put will have likely already lost a lot of value. Now that also works in reverse. If a stock trades up to a resistance level, that doesn't mean a stock has to pull back. But in theory, the odds that it will has gone up. In fact, look at what happened to Nike after I exited the trade. Yes, for a few days, the shares continued pushing deeper into that 75 to 77.50-ish congestion area, and then really sold off. So much so that Nike actually traded below that $70 strike price of our original short put position. Now, Nike would recover pretty quickly from those lows and trade back above 70. And if the original trade had been held until the February expiration, those $70 puts would have expired worthless. So everything would have worked out just fine in the end. But this example really illustrates how quickly a winning trade can turn into an underwater trade if you don't respect resistance levels or other technical warning signs. Okay, to quickly summarize, to know when it makes sense to exit a winning put selling for income trade early, run the numbers on the potential profits you're leaving on the table and annualize that as though it were a new trade. The lower that rate is, the more you might want to lock in gains and look for better opportunities. Also, keep an eye on the technicals to see if you can identify any potential trouble on the horizon. You only need one factor to trigger an early exit, but as we've seen, you'll frequently see both raise their hands around the same time. Okay, if you enjoyed this and want more, be sure to check out the channel's other videos. I recently took about a 7-year hiatus from posting, but I'm back now and adding 5 to 10 new videos per month. Also, sign up for the Daily Tips newsletter via the pinned comment below. Options are seriously like having a superpower, and I can show you how I develop mine and how you can develop yours. Okay, until next time.